Hello and welcome to the 2020 edition of the Mar Digby Client Seminar. At the start of these events, I normally ask you to turn your phones off, point out where the toilets are. This year I'm just going to assume you know where the toilets are. This event had been booked in both Maroochydore and Hervey Bay at the respective RSL clubs, but since the time of booking through to now, a heck of a lot's obviously happened. It's hard to find any venue now that allows 60 odd people to gather together in close proximity. So this is what we've had to do this year. In terms of our business, we are continuing as normal, or as normal as we can. The three of us are still working, albeit in different locations. I'm coming into the office still every day. Tanya's been set up at home with a laptop and access to all the information that she needs in order to make the transactions happen that are requested, as well as continue producing portfolio reviews so that we can send them out via email, which is different to obviously what we've done in the past. But it's working. Diana had to cut her trip to New Zealand short as well, and she's now working from home as well, and this project has been her baby, and this is obviously the result of her work there. I've spoken to many of you since the start of the coronavirus crisis, or call it what you want, and it's a credit to you all in terms of how everybody is doing the right thing and adapting to this weird, eerie new world. Things, fortunately, seem to be under control more so now than what they were, and I think we're lucky to be in this part of the world as opposed to some of the Northern Hemisphere countries that we've seen this virus make an absolute mess of. We've continued to do the reviews, like I said, and also spoke to a lot of you at the time where the allocated pension payments were being reduced, and a lot of you have chosen to reduce your incomes while we haven't got the opportunity to spend the money on holidays and other things that we ordinarily would. The world's meant that we've had to adapt in many ways. We've had to get groceries delivered from online supermarket services. We stood in our driveways during Anzac Day, and this is our way to adapt in order to bring to you a client seminar. And what we've come up with for this year is the opportunity to hear from 4 different fund managers. We've chosen 2 Australian share fund managers and 2 international share fund managers. And we've basically given them the brief to talk about their fund in the first week of May. Things are obviously happening very quickly, so we've wanted them to all talk at approximately the same point in time. And in terms of the Australian share fund managers, we've been able to get people from Bennelong and Montgomery. We've also had people from Platinum and Magellan put together a 5-minute presentation just talking about their fund. If we're looking for silver linings, I guess the thing is that we've been able to get people to talk to you that we ordinarily wouldn't be able to bring up from Sydney. From Bennelong, we've got the investment director of Bennelong, Julian Beaumont. We've got from Montgomery, Roger Montgomery, who obviously is the founder of that organisation and heads their Australian share fund. From Platinum, we've got Andrew Clifford. He's the co-founder of Platinum and the head of the Platinum International Fund. And from Magellan, we have Chris Weldon, who is an assistant portfolio manager with that firm. So sit back, relax, enjoy and learn as we hear from each of those different fund managers in turn. Our first speaker today is Julian Beaumont, the Investment Director at Bennelong. Julian, the last time I saw you was the 19th of February in your office in Sydney. Fair bit's happened since then. How do you see the markets now?
Yeah, obviously a lot's happened since then. We actually hit a peak 4 days thereafter that meeting. And since we've had a really big downdraft, there's obviously a lot of uncertainty around the coronavirus that remains, although we've had a flattening of the curve, governments have got on top of it, but there still remains a lot that is open-ended. The tussle right now that markets trying to get their head around is, on one side, the government's doing a reasonable job on controlling it. They are a lot of large E's in terms of fiscal stimulus to build a bridge to the other side. And there's central bank stimulus at the same time. That's all very helpful. The other side of that, though, is the economy's basically in a slumber. Jobs are being lost, businesses closed, economic and corporate profit growth is well down. And mixing all of that into the scenarios and how it plays out, including how the coronavirus plays out in terms of potentially new spreads and the like, is very uncertain. And in this environment, I think you want to be pretty flexible. There's a broad range of scenarios in front of us that can transpire, and building a portfolio from our point of view that can adapt, but see ourselves through all the troubles and the uncertainty and get through the other side with the value intact.
Your portfolio itself, or your fund, has got an outstanding long-term track record. How has it performed during this downturn?
Yeah, sure. The market's obviously fallen quite significantly, and in that environment, we have also fallen in absolute terms. We've actually fallen somewhat less than the rest of the market, which is to say that we've beaten the market or outperformed the market. Now, that's probably not entirely great news for your clients, although it does build off good returns over time. And over time, though, that outperformance that we've been able to generate in this down market, but also over long periods of time, does benefit the clients on a longer term basis. That's very helpful in terms of retirements and what have you. Over the last three quarters, so February, March, and April, the market's been off something like 21%, and we've been down closer to about 17%. So there's probably 3 to 4% of mitigating of losses for clients. That's held up off the back of a pretty high quality portfolio, really strong balance sheets that have the financial to get through these difficult times, and then just really robust competitive advantages, leadership in their industry, and so with values that are going to hold and remain intact through this, we believe, with the upside to come through once we get through it all.
Yeah, but we often say that when the markets are low, the share market's on sale. What sort of opportunities have you been able to find?
Yeah, it's interesting. There are a number of opportunities. The market's on sale right now to a large extent. You know, clearly we're off those highs that we had in the market 4 or so days after we last met back in February. And where we're really focused on is some of those real industry leaders. They might they have something about them, a competitive advantage, a brand, a way of doing things, intellectual property that is going to see itself through these troubling times. Now, they need to have the balance sheet and the earnings mix to be able to get through the next period for however long it could be, and it could be quite protracted. So names we're really hitting towards are not necessarily the financials. There's a lot of credit and other risks amongst a lot of those companies. A lot of the beaten down stocks that are in the travel, education, other sectors, we're not really chasing too much. We're really focused on consumer industrial companies with real industry leadership that we think that through their strengths, they become something that gets them through this period, but extends their competitive leadership as against their competitors. And so actually they come out of this in better shape. Examples would include their James Hardie, which is a leader in its building products category, Aristocrat with online social and slot machine games, Reliance Worldwide with unique and niche plumbing fitting products, Seven Group that's benefiting from mining continuing. They're selling the bulldozers through the Caterpillar franchise and the like into not just mining, but also construction. And there's a fair chance that we do have some sort of infrastructure-led fiscal stimulus coming out the back end. So they're unique names. The way that we generally invest is very stock specific. We don't go too thematic. We worry about the individual fundamentals of every particular stock. And so it's very much been stock by stock in terms of the opportunities where we've invested, where stocks have been sold down and we think too far for the quality of the business and the longer term growth prospects, even if they might not be earning those and growing those earnings right now, but just those longer term values that we're attracted to with prices being down.
Fantastic. Julian, really appreciate your time and your insights and look forward to catching up with you later on.
Pleasure.
Hi, I'm Roger Montgomery from Montgomery Investment Management, and on behalf of Mar Digby, thank you for the opportunity to present to you today, and thank you also for selecting the Montgomery Fund for your portfolios. Montgomery Investment Management is a team of 16 dedicated professionals who've been managing money for almost 10 years, 9.5 years to be precise. The Montgomery Fund, the fund that you have selected, is different to many other funds in that it has a variable cash component. We have the ability to hold up to 30% in cash at times we see there are no opportunities that meet our criteria, or when we see a freight train coming, such as, for example, coronavirus. The Montgomery Fund has outperformed its benchmark and many of its peers with an average of about 20% in cash since its inception. At the moment, the Montgomery Fund is holding a very high level of cash, believing that after the recent bounce, very few opportunities are currently available that meet our criteria. But what is our criteria? Well, there are three components to what we're looking for in an outstanding opportunity. Number one, we're looking for a very high quality company. Now, I know many people have different definitions of what quality is. Ours is fairly specific. Our first prize is a business that's able to generate very high rates of return on incremental capital. We're looking for businesses that can keep generating high returns, usually because they have a sustainable competitive advantage and they're able to retain, if they want to, very large proportions of their profit and reinvest it at a high rate of return. Over very long periods of time, there is a strong correlation between share price performance and return on invested capital, which is one of the reasons why we look for high rates of return on incremental capital. The second criteria that we're looking for are bright prospects. We want a business that has a bright future, either because it's going to sell more of its goods or services, or it can sell the same quantity at a higher price. In fact, earlier I mentioned competitive advantages. One of the most valuable competitive advantages is the ability to charge a higher price for your product or service without a detrimental impact on unit sales volume. And there are many companies in Australia that meet this criteria. So we're looking for bright prospects and a high quality business. The third criteria that we're looking for is a rational price. Ideally, we'd like to be able to buy these businesses at cheap prices. So that's it in a nutshell: high quality, bright prospects and cheap prices. When we can't find companies that meet those three criteria, we tend to hold cash. And we're very disciplined about that. During the bull run prior to coronavirus, we were holding a very high level of cash. After the sell-off, we started to dip into the market a little bit more, but the recent rally has meant that we've held off investing too much of that cash. So we remain at very high levels relative to our limits. Now, what do we believe is going to happen next? I'll finish up on this point. Number one, the recent rally seems to be disengaged from the reality of the economic impact of the coronavirus-related shutdowns. Do we believe that the market could fall further? Yes, we do believe that it could. Do we know? No, we don't. And so we will continue, rather than forecasting markets, we'll continue to look for companies that meet our three criteria. Now, we believe there is merit in holding defensive, large cap, high quality asset-based companies at the moment. However, this will change in the future. If we believe that prices are sufficiently low, and we believe that the bad news with respect to coronavirus and the economy have passed us, we don't need the future to be bright and for everyone to agree. We just need the worst to be behind us. Then what we'll start doing is moving out of those more defensive positions and into companies that we believe are better leveraged to the recovery. You'll see changes in our portfolio as we make those decisions, but for now, thank you for joining me. And again, thank you for welcoming us into your portfolios.
Hello to the team at Mard Digby, and thanks for this opportunity to talk to you all. It may feel like forever since value has been outperforming the market, and yet it was just 2 years ago that our Platinum International Fund was compounding at 25% per annum, and that at the time was well ahead of the MSCI World Index. Back then, value was working. Back then, it was a period of global synchronous growth. And it wasn't actually an exceptional period. Global growth in 2017 was just 3.2%, close to the trend that it has achieved for over the last 40 years. But today, everything feels so different. Going back to 2018, we started to see monetary tightening across the world. Then, of course, we entered into the period of the trade war between the US and China, all of this impacting economic growth. And then finally, we end up in a global pandemic. This sequence of events has led to a significant slowdown in the global economy and has resulted in investors rushing out of companies that are sensitive to this economic growth. For example, the emerging markets, industrial companies, materials and energy businesses have all been avoided by investors as a result of this slowdown. And what they've sought instead is absolute safety into the staples, companies such as Nestle, real estate trusts and utilities on one hand, or they've looked for high growth companies that would grow irrespective of the type of economic environment we're in. Many of these found in areas such as e-commerce, payments and technology in general. Now, of course, such a strategy seems perfectly sensible. And on one level it is, except for the fact that the most important determinant of what you earn as an investor from stocks is the price that you pay for them. Investors today are paying very high prices for safety and for certain growth. And in doing so, they are leaving behind many fine businesses that have become extremely undervalued. But in my 30 years of markets, I haven't seen such a wide group of companies trading at attractive prices as they are today. Let me give you just 2 examples. The first company I'd like to talk about is Micron. Micron is a US semiconductor maker. It manufactures the DRAM chips and the flash memory chips we need for our computers and phones. This used to be a terrible industry as companies raced to be the first to the next generation of chip. Supply of chips was always in excess of what was required, or nearly always. Profits were erratic, and there were always new players coming into the market. At one stage in the 90s, there were 12 producers globally of DRAM chips. Today, the industry has consolidated down. There are just 3 producers of DRAMs globally, and with huge barriers to entry in terms of intellectual property and manufacturing know-how. And in the flash memory chips we use in our phone, there are just 5 makers today. And the profitability of this industry over recent years has improved out of sight. These chips are at the absolute centre of everything that is exciting in technology. Wherever we do computing, we need memory chips, whether that's artificial intelligence, the cloud, autonomous driving, or just simple e-commerce or streaming of Netflix. All of them need their chips. At the moment, the industry is in a down cycle. Last year was weak, and 2020 is hard to know quite what's going to happen. But Micron today has no debt. Indeed, it has $2 billion at cash at its last balance date and is trading on just 1.4 times book value. Our assessment is that the company can earn profits over the next cycle that on average will put the company on a price earnings multiple of just 6 times. That means we're getting an earnings yield of 17% based on the price we're paying for this stock today. To us, that represents a very good return. The second company I'd like to highlight is Ping An Insurance. Ping An is a Chinese life insurance business. To give you a sense of the enormity of this business today, it is 10 times the size of Australia's biggest insurers, so indeed a very serious operation. Its operations span from life insurance, general insurance, banking and fintech. Indeed, it is probably the leading fintech company in the world today. It leads the world in the application of technology in its insurance business. For example, if you have your auto insurance with Ping An and you end up in a crash, you simply take a photo of the damage to your car, they know where you are, they know when it's happened, you upload that photo and they instantly process the claim using artificial intelligence on that photograph and will book you in to the repairer. Compare that with the process you have to go through here. This company has been growing strongly for the last 2 decades at an average of 20% per annum. That is as good as just about any large company you will find anywhere in the world. But today, we can buy that stock on 9 times earnings. That is a starting yield of 11%, and a yield that we expect will continue to grow at very high rates for some time to come. This, we think, makes an excellent investment. So in summary, today we are indeed in a global recession, and it is exactly this type of environment which will see the markets continue to throw up exceptional opportunities for stock market investors. This will create the chance for strong returns when the world returns to work. At this time, though, it will be in the presence of a likely very large government spending, and what we don't know is exactly what impact that will have on interest rates longer term. We think the combination of these events will create exceptional outcomes for those that are not following the herd. Thank you very much for your time today.
Hello, everybody. My name is Chris Weldon. I'm one of the portfolio managers at Magellan. I just want to start by expressing a very sincere thanks to Maha Digby for the opportunity to provide this update. What I want to spend the next 5 minutes or so talking through is 3 different topics. Firstly, we're just going to give a quick update on the macro view that we've got at the moment. Secondly, how we're seeing markets. And then thirdly, the portfolio positioning for the global strategy at the moment. So first of all, to start with the macro view. And what I want to do is take you back to sort of late Feb, early March, when we started really first thinking through the potential coronavirus-related issues. We came up with a framework of 4 potential macro scenarios. And those 4 scenarios have really informed the decision-making we've made and the portfolio changes that we've made over the last couple of months. And so those 4 potential scenarios that we had in mind, first of all, was a V-shaped cycle, a sort of short and sharp downturn but a quick recovery. Secondly, was a slightly longer U-shaped cycle. Thirdly, was a prolonged, deep multi-year recession. And then fourth, potentially was a depression. And as we reflect back on the decision-making in sort of late Feb, early March, at the time, all 4 of those scenarios were very much in the viewfinder for us. And we were ascribing a fairly equal probability to all 4 of those scenarios, which is to say that, you know, we couldn't be certain, but we foresaw potentially some very negative scenarios on the horizon. And given one of the objectives of our global strategy, as you know, is to protect clients' capital in adverse markets, we thought there could be some adverse market environments on the horizon. And therefore, we acted quite dramatically in early March to change the positioning of the portfolio, to have a much more defensive posture in the portfolio. And I'm going to come back to that, but it was really informed by that macro view that we had in those various 4 scenarios we're considering at the time. Now, sitting here today in early May, obviously more time has gone by, we have more information at hand. And as we're reflecting on the data today in those 4 scenarios, we'd suggest the probabilities of the first V-shaped cycle and the 4th depression cycle, the probabilities of those have probably decreased quite meaningfully. And the base case, the sort of central macro view that we're working towards the moment, we think is most likely are those 2 central cases, the U-shaped cycle or the prolonged deep multi-year recession. They seem most likely as we sit here today. The V-shaped cycle is quite unlikely because sadly too much time has passed and the virus has spread so widely in so many economies around the world. So the probability of that scenario has declined meaningfully in most advanced economies. Likewise, the depression scenario seems to have reduced in probability because we've seen very large coordinated policy responses around the world, monetary policy responses and fiscal policy responses, and also health policy responses in terms of the social distancing that we're all practicing in various countries around the world. So all of those things together seem to decrease the probability of a depression. But where we land now in terms of those 2 more likely central cases will still very much be determined by the policies we've seen to date, as well as the policies we expect that will be required in the coming quarters and potentially years. And those policies will focus both on the health side of things, as we're going to reopen economies and how we can do that successfully without creating a second wave or a third wave. And so that speaks to testing and tracing and all those sort of policies. And then the second area of policy that will be required going forward, of course, will be further economic policy, further fiscal policy support and monetary policy support to help economies recover in due course. And there is a huge amount of uncertainty in both of those areas still in our mind. The health uncertainties, whether we'll get a successful vaccine, a successful therapeutic, when that could happen, how successful economies will be in reopening without causing second waves and things like that. There is an enormous amount of uncertainty there. Likewise, there's still, in our mind, a very high degree of uncertainty in terms of the short, medium, and long-term economic developments associated with this crisis. So though we are moving towards those 2 central cases, there's a more likely cases in our mind, those probabilities are going to keep moving around in time. And we'd characterize this environment as a very low conviction environment. We don't know what's going to happen, to be honest. No one does. There's no playbook for this. It hasn't happened before. So we are still very cautious because of that uncertainty. I'm going to come back and touch on the positioning in a moment. But secondly, I just wanted to touch on the current market environment because in spite of that uncertainty that I just mentioned, equity markets have rallied quite strongly through the month of April and into early May. And of course, we don't know the reasons that has happened, but potentially 2 contributing factors might first of all be that the health data at the margin seems to be incrementally positive. We are seeing evidence of curves being flattened around the world. Active case numbers are falling in certain economies around the world. So that is incrementally positive news. That's pleasing, and markets seem to have responded to that. And potentially the second dynamic that has supported equity prices through April and May to date would be the degree of policy intervention. We've seen some very large monetary policy and fiscal policy developments in many advanced economies around the world, and markets may have taken some comfort in those developments more recently. So the third area I want to cover, and just to sort of wrap up this short update, is portfolio positioning. And as I think about where we came into the year at the start of 2020 and contrast that to where we are today in terms of portfolio positioning in the global fund, we came into the year with cash at about 5%, so close to fully invested, and our combined risk ratio, which is sort of a risk sensitivity to market, that was sitting right at a 0.8 cap that we run the global fund at. So in our world, it was a pretty risk-on portfolio. We didn't foresee too many macro concerns right at the start of this year. But if you contrast that positioning to how the global fund's positioned today, we have cash sitting at about 17%, so a meaningful increase in the cash levels in the fund. And we've also reduced that combined risk ratio measure down from about 0.79 to about 0.68, which is quite a defensive posture in our world. And we've reduced the risk settings in the portfolio. We've reduced that risk ratio, first of all, by increasing cash, but also by changing somewhat the composition of the equity investments in the global fund. We have been trimming our positions in the more economically sensitive businesses and businesses with a high degree of emerging market exposure. So those sort of businesses might be our luxury companies like LVMH and Estee Lauder, or the digital advertising companies like Alphabet and Facebook. Even our payments companies are quite exposed to short-term challenges related to the coronavirus and the inability to travel around the world, which is a very profitable part of the card networks business. So we've been trimming those positions. We still own them. They are fabulous long-term investments. They're very well positioned for the long term, but they do face some short-term challenges associated with this environment. So we've been trimming that exposure across those sort of businesses. The proceeds from those sales and those trimming actions have gone towards increasing cash, but also we've been increasing our exposure to very defensive equities, consumer defensive businesses, utility businesses, infrastructure businesses, healthcare companies that have cash flow profiles that are largely immune from economic developments in the short term and the medium term. So we've used the opportunity back in sort of early to mid-March during that volatility to add to those positions in the global fund. And then we're retaining our positions in the enterprise software companies like Microsoft and SAP. They're performing incredibly well during this environment, given the very resilient nature of the software that they sell to companies all around the world. We've retained our positions in the Chinese technology platforms, Alibaba and Tencent, which have really benefited in this environment. The trends that were in place, the digital cloud computing trends, the digital payment trends, the e-commerce trends, all those things that attracted us to those businesses have really been accelerated during this period. And so they've been key beneficiaries of those recent developments. And then there are some smaller holdings in some of our brewers, a hospital operator, HCA Healthcare in the United States. We've trimmed those positions a little during the first quarter, but they were quite small positions to begin with. So to wrap up, we still have a very cautious view from a macro point of view at the moment. There's still a huge amount of uncertainty, both with regards to the health outcomes and the economic outcomes in the months and quarters ahead of us. And given that view, and given the objective of the global fund of protecting clients' capital in markets like these, we've shifted the portfolio during the first quarter to a much more defensive positioning, but still have some wonderful resilient businesses there in the rest of the portfolio. So with that, I'll wrap up. Thank you again very much for the opportunity to provide this update. Take care, everyone. Stay safe, keep well. And thanks again, Maha Digby, for the opportunity. If there's any further questions, please speak to your advisor. And if need be, they can reach out to Magellan. Thanks again.
So there we have it, the 4 speakers giving us an update on each of their funds. Now, the 2 Australian share funds with Bennelong and Montgomery, they're 2 of the newer fund managers that we've started using within the portfolios. If we haven't got them into your portfolio yet, then that is part of some changes that we are currently making at review time. And obviously Platinum and Magellan, they've been part of our clients' portfolios for many, many years. In terms of those talks, I think there were three key themes that came out of it. Obviously, uncertainty plays a big part at the moment, and it's important that we do have a very careful investment strategy going forward, and I believe that each of those fund managers do. Secondly, the funds certainly aren't down as far as what the markets are down, and that's attributable to the good investment decisions that each of those fund managers have made and the sort of companies that they've invested into. They're obviously looking to buy businesses that are going to come through the other side of this. And thirdly, there are opportunities there. The markets have fallen and good quality businesses have become cheaper. And it's a matter of finding those good quality businesses that have become cheaper, not just buying businesses because they're cheap. Otherwise, we'd have all piled into Virgin, and that wouldn't have proven to be a very good idea. But we certainly got an idea of some of the companies that the fund managers have looked at. So look, that wraps it up. You made it, and this is normally the part of the day that everyone looks forward to because there's a free lunch. Unfortunately, this year there is no free lunch. You've all got to cook for yourselves, and I'm sorry about that. But I hope that this has been useful in order to keep you updated. They are uncertain times. I do look forward to catching up with each of you in person, hopefully in the not too distant future. But until then, take care, stay safe.